For some more insights right now on the capital markets, want to bring in Oksana Aronov. I never get your last name properly, and
Aronov, you got it.
Sound it out. Head of market strategy for alternative fixed income at JPMorgan Asset Management. Good morning.
Good morning
to you. Just help us understand what's going on here, because we've been on this sort of wild run. Things seem great, but then you sort of read these articles about just how confidence is disappearing, and you're sort of trying to make some sense of it.
Policy uncertainty is not a friend of animal spirits, right? And it's really that simple. And we have a lot going for this economy, and on balance, the data continues to come in strong. But certainly, there are some softer data points coming out. We also have a lot of uncertainty, obviously, around what's coming out of Washington. What are these DOGE layoffs going to do? Will that eventually kind of put a dent in the cocktail that we currently have, which is a tremendous amount of deficit and debt, right, in an environment of full employment, which generally is a recipe for higher inflation, which is what we've seen. And of course, this administration is hoping to support and unleash animal spirits, but policy uncertainty is an enemy of that.
And therefore, you think what happens?
And so there are a few sort of competing things going on right now. But for the backbone of the market, so to speak, right, which is the 10-year Treasury, which is the level of yields, that is poised to stay elevated for longer and possibly move even higher, because all of the things that contributed to move higher are still in place. We still have tremendous amount of AI data center spending. We still have tremendous amount of fiscal spending. We still have a resilient consumer that continues to spend. That all of that Treasury issuance coming out of Washington is going to create a floor, because it's unclear where is the demand going to come from for all of that issuance as our balance sheet doesn't look.
I don't know if you heard, Steve Cohen was down at this FII event where Trump was last week. And I don't know if it took bravery or whatnot, but he basically came out quite publicly and said that he was dumping stocks, that this was going to be a very tough environment, that actually things had run their course, and at least for the short term, that it was going to be a very hard place to play. Do you agree with that?
So I think that's frankly impossible for anyone to call. That's the top of the stock market. We do know that in the
I don't think he was calling the top necessarily. I think he was saying right now is just, it's almost too difficult, and that we had this sort of remarkable run, and that maybe there's going to be a pause.
And it's certainly plausible. Remember, in 2018, we did have a 20% pullback, in 15 to 20% pullback in the stock market under the first Trump administration. So it's not unthinkable that an administration that comes in with a certain agenda, which is generally positive for the bottom line of the capital structure, can still create this kind of volatility. What really is very fascinating to me as a credit watcher is that all of this uncertainty is creating a lot of angst around stock valuations, but we're not seeing anything happening in credit valuations, which are absolutely, without a doubt, the richest we've seen possibly ever. The amount of light, or the tiny amount of light between high yield spreads, which are junk rated, and cash has never been smaller.
Why do you think that is?
I mean, that's really the perplexing thing, is that there's so much complacency around this credit risk in the lower rated part of the credit market, and yet we're all completely focused on the S&P. Of course, all eyes are on NVIDIA earnings on Wednesday, right? And there's all this sort of dissection. And yet I think where there is absolutely a top of the market right now is in credit, particularly lower rated credit. And we will most likely see a meaningful spread widening there. And I think that's going to be a greater opportunity in the short term.
Multiples are high, all right?
Multiples are high,
and we know that.
By any measure.
And I don't expect necessarily any help from the Fed to keep multiples.
And in some, the perverse thing about where we are today is that bad news is good news, right? So if we were to continue to see markedly slower, softer
that would
data,
be good, because
that may be good, because people are so used to mainlining this liquidity, right? And
that's
so
exactly
the
what we were
Fed's
saying.
put will have been assumed to be alive and well.
Right now, we're down 2.5%. Do you think that the positive animal spirits from deregulation and even the prospect of cutting government spending is net offsetting some of the policy uncertainty about tariffs?
I think that's the question that no one can answer right now, because there's so much policy uncertainty. And year to date, we're still doing okay on the S&P. I think the consensus generally is it's going to be a single-digit year. But again, to me, where investors really should...
Single-digit up?
Yeah, I mean, that's the consensus. I mean, who knows? And generally, look, so earnings have come in okay. I think what's been lacking is the positive forward guidance, right? And that's what the market wants, and that's what it got throughout 2024, where initially companies set the bar lower and then they came in and kind of had a lot of positive forward-looking guidance, and we're not getting that today. But to me, where investors really should get used to no meaningful price returns is fixed income, is credit. I think investors have gotten very used to that in the years leading to 22, and it's going to be a completely different ballgame, a much more tougher one and a choppier one.